I bought a new stock this week. And while I think it's probably just as much luck as it might be skill, it's surging after it reported earnings. So, what is this new stock in my portfolio and what's going on with the company? My name is Brian Stoffel. At the time of this recording, obviously, I own shares of the company we're talking about. I want to give a shout out to Fiscal AI for sponsoring today's video. But of course, let's talk about what that stock is. It's none other then Cloudflare, ticker symbol NET, a content delivery network which has become kind of a behemoth of many other things. And shares are up when I took this screenshot 9%. When I last checked, up about 13% after hours after the company reported earnings. Again, want to give a shout out to Fiscal AI. We'll get to them in just a minute. But some people might be confused. They might be saying, Brian, you made a video last week talking about how you sold Cloudflare. And that's true. I did make that video last week. However, it is worth understanding the timing because I don't always release my moves immediately on YouTube. I have a paying community that part of the benefit, although I would argue not the main benefit, but part of the benefit is they get to find out what I'm doing in my own portfolio right away. For instance, they knew, and I've got the timestamps to prove it, that I purchased a huge slug of Cloudflare about a year ago during the Liberation Day tariffs when it dropped to about $100 per share. And then I started trimming a little bit in October at $215 a share. And then this is when I completely sold out in late December at about $195 per share. However, I bought back in this past week. And I did that for three reasons. Now, the first two aren't all that important. One is that this earnings was coming up. The other is the stock was down about 15% from where I sold out of it, which is all fine and good. But the real reason that I bought into it was because between when I sold and when I bought back in, Claude came out with their co-work tool, ChatGPT with, excuse me, with their frontier model. And when I saw that, I saw, boy, there is going to be a lot of demand for what Cloudflare has. I think this shifts the narrative, at least my understanding of it, quite a bit. So let's go over the headline numbers. This was Cloudflare's fourth quarter of 2025. The market cap will be somewhere around $70 billion when the market opens tomorrow. Revenue came in at $615 million. That is 34% growth and well ahead of both analyst estimates and management's guidance. Earnings per share on a non-GAAP basis, which excludes a whole lot of stock-based compensation, was 28 cents per share. A lot of growth from the same time last year and ahead of expectations. Now, all this being said, there's some ugly stuff in here too. First, let's look at gross margins. They contracted meaningfully. Now, it's important to point out this is on a non-GAAP basis, and stock-based compensation and depreciation and amortization does take away from this. However, all that being said, while this gross margin did contract, it was just below management's stated long-term guidance for what they hope it to be. Operating margins on a GAAP basis, that includes all that stock-based compensation, actually got worse. Net margins improved, but you got to accept that depreciation and amortization and huge swaths of stock-based compensation are going to be part of this. Now, on the other hand, free cash flow more than doubled. Net income was about the same. And despite all of this, the company is in solid financial footing with about $4.1 billion in cash, about $2 billion in debt. A lot of that is senior convertible notes that are probably going to disappear, but they will dilute shareholders even more. So it's worth keeping that in mind. Dilution is part of what you're getting if you buy shares of this company. Let's go top to bottom on the income statement to see what's happening. Revenue is up 34%. However, the cost of that revenue is up 49%. We already talked about that. Management, they came in better than expected in the year ago quarter, slightly worse than expected in this quarter. That said, there's a lot of moving pieces and a lot of new products and tools that are coming online that do change the gross margin profile a little bit. That is why gross profit, I coded it red because it did not grow as fast as revenue. However, the company was able to control operating expenses, including stock-based compensation. That grew slower than revenue, so it's coded green. All things being equal, though, the operating loss widened by 42%. That is, of course, something that the company does need to fix. However, investors, myself included, are willing to give them a pass right now. And I think you'll see why as we go along. It's also worth pointing out that the weighted average shares outstanding did increase by 2%. And of course, they probably will increase even more. Now, there's a lot of moving pieces here, as I said, when it comes to Cloudflare. And for more detail on that, we're going to head on over to Fiscal AI. Now, we partner with this website. They advertise with us because we believe that it's one of the best free tools out there on the web. You can click the top link in the show notes below. You can use it for free, but if you want full functionality and a year-long membership, if you go there using that link below, you will get it for 15% off. So the first thing that I want to show here that I think is the most important is this is the revenue growth rate at Cloudflare. And as you can see, coming out of the pandemic, just coming out of early 2023, the growth rates were slowing, but we have really seen the increase in traffic start to show up for Cloudflare. And this is incredibly important in the age of AI agents, which I'll get to in a minute. But for now, just know that at the end of last year, really the beginning of 2025, the company was growing at 27%. It's now growing at 34%. And we can't understate how important that is. Now, if we look at what's expected, it's expected to slow and then increase. But I wouldn't give these analyst expectations too much credence. Now, you can only see these if you get the paid version of Fiscal AI. But here's why I wouldn't give them too much credence. If we go back and we look at, well, how accurate have analysts been in the past? What we see is that over the last 2 years, they have been underestimating. Cloudflare's revenue has been, the estimates have been increasing in that time. But that's not all. There's a couple other things that I think are worth looking at. This right here shows the total number of paying customers that Cloudflare has. And notice that they got roughly, I mean, if you look at this, 37-ish thousand more paying customers in just the last 3 months of the year. I mean, that's really impressive. And the growth rate is going up by leaps and bounds. The number of customers they had was growing by just 13% about 3 years ago. And now it's growing 40%. That is incredibly powerful, but it's not all. So that was paying customers. Let's look at the total number of customers that pay over $100,000 per year. And again, what we see here is that growth rate is coming down. However, it's flatlining and is actually reaccelerated ever so slightly the last 3 quarters. But if you can flatline the number of customers that pay you at least $100,000 per year above 20%, that is enormously positive. If we look at the remaining performance obligations, this one I really want to talk about because this is impressive. Now, what you need to know about Cloudflare, the way that it works is there's some flexible pricing, but it's all usage-based. It's based on the amount of traffic and compute going through the company's servers, which are spread out throughout the world. And so you have to prepay this usually. And so RPO really does represent, for the most part, money that the company has collected or is contractually will be obligated to be paid in the future. But they haven't been able to recognize it as revenue. And so what I want to point out here is that in just the last 3 months of the year, the RPO grew by hundreds of millions of dollars. And even more than that, the RPO was growing by 30% in the end of 2023, and it is up to growing 48% as there's more usage happening and there's people signing larger annual contract values. I mean, it has been accelerating now for over 1 year. And that growth rate, 48%, being faster than the revenue growth rate of 34%, means that the pipeline for growth is still very, very strong. One last thing on Fiscal AI that I want to show you is the company's dollar-based net retention rate. Now, what this means is that if you take all the customers that Cloudflare had at the end of 2024, forget all those customers we just went over that they gained in the last year. If you take those customers and you say, take that cohort, how much are they spending today? If it's 100%, then on average, you've held on to all of your customers. If it's above 100%, you've not only held on to them, but you've gotten them to spend more. And look at this. This is also reaccelerating over the last 6 quarters. So what that means is not only is Cloudflare hanging on to its customers, but it's getting them to spend 20% more per year. And I shouldn't need to explain what a huge deal that is. Now, here's the other thing that I think is really important. Just earlier today, Brian Feroldi and I had a webinar talking about what type of companies are going to survive and thrive in the era of AI agents, because AI agents are what everyone's talking about, and rightfully so right now. And we said it can come down to 4 different lenses that you can view it through. And what you need is you need at least one of them to be anti-fragile. If you can get 2, that's great. But let's look at Cloudflare. So the first lens we looked at is the cost of failure high? Because here's the thing. If the cost of failure isn't high, well, then large language models will largely, they can replace what you've got. But if the cost of failure is high, then that's a big deal. And with Cloudflare, while I know they're not technically a software company, but with Cloudflare, the cost of failure is incredibly high. We've seen that when they have outages. So it is very anti-fragile. What about business models? Fragile business models are going to be ones that are seat-based. But Cloudflare is not seat-based. It is usage-based. It gets paid from capturing the value from productivity, not the total number of people using a tool. So it's anti-fragile there as well. Next is, does the tool you're using require real world feedback? And in fact, it does. Cloudflare has hundreds of data centers spread out throughout the world to narrow the number of milliseconds it takes to have that content delivered to the edge. And that also makes it anti-fragile. I would say it's not quite the same type of anti-fragility as you get when there are sensors on hardware, like say Axon Enterprise has, but I'm willing to at least give it a robust rating. And then finally, does the data get better as more agents join? And because Cloudflare has gone beyond content delivery networks to many other things like cybersecurity, or we heard on the conference call talk about the workers developers platform over and over and over again. Yeah, that proprietary context is a big deal. So this is why Cloudflare is such an important stock to own, given especially the developments over just the past couple of weeks. Now, when we look at guidance, there's even more to like there. So management guided for 30% revenue growth, and analysts were estimating just 29% revenue growth. While the earnings guidance on a non-GAAP basis fell short of analysts' estimates, right now this is more of a top-line story because they are capturing market share. And once companies start building things on top of Cloudflare's ecosystem, the switching costs are high there. So there's both network effects and switching costs. And when those combine, it makes sense to go after market share at the expense of perhaps profitability over the short term. Management said on the conference call that agents are interacting with other agents and the web at a volume that has never been seen before. And so looking forward as a shareholder myself, here are the 4 things I'm going to be watching. Number 1 is revenue growth. I want to see if it can continue accelerating moving forward, but I want to see it above 30% at the bare minimum for the rest of this year. Second is guidance, because I wouldn't be surprised to see management continually up guidance. They did guide for 29% growth for the full year. Nobody that's keeping a straight face about this should actually believe it'll come in below 30%. Number 3, remaining performance obligations. That's going to be really big. Those contracts that they're signing really are a sign of growth coming down the pipeline. And I do care about the company being able to manage some level of profitability. And for that, I will keep an eye on free cash flow. The moat is definitely widening around this company. The thesis is definitely on track. It is worth looking out for stock-based compensation dilution. Of course, that leaves us with the question, what about valuation? That is really important. Before I get to that, I want to let you know that I've been tracking my own portfolio's returns since the end of 2014 up until this was the beginning of February. You can see my returns in the green. The S&P 500s is all the way down there in the red, and the NASDAQ is also below mine in the yellow. So how does stock investing mentor work? This is a program that I have developed that you can use, and it comes in 3 parts. Number 1 hour of live weekly training sessions every Thursday at noon Eastern that are recorded that cover a topic relevant to individual investors. Number 2, You get full real-time access to my portfolio, as well as a video explaining any moves I make in that portfolio. And number 3 is 24/7 access to a private online investing community. And that's where they found out, for instance, earlier this week that I bought back into Cloudflare. If you would like a full year membership to Stock Investing Mentor, click the second link in the show notes below, and you can actually get 10% off a full year membership. It is worth noting that deal will end at 11:59 p.m. this Thursday. So let's talk about Cloudflare's valuation. Now, we could look at a couple of standard metrics like the company's price to sales ratio. So if we pull up its price to sales ratio, I want to pull this back a little bit more. So this is since the company went public. What I want to do is we see right now it's trading at a forward price to sales ratio of 24. Now look, no one's going to argue that that's cheap because it's not. But over the last couple of 5-6 years, it's traded for about 19 times forward price to sales. So it is above that, slightly expensive based on trends in the past. What about if we look at something like the price to earnings ratio? Well, this one's going to get kind of messy. I would say that, as you can see, it's a messy background. It doesn't really tell us much. But one that I do think is worth looking at is the price to operating cash flow. And so if we pull this forward to just kind of look at the last 4 years, what we see here is it's trading for about 86 times forward operating cash flow. And that's actually more or less right in line with where it's been over the past couple of years for all of the reasons that I've already mentioned. But of course, my favorite way of doing this is doing an optimized reverse discounted cash flow analysis. Now, here's how we do this. The first thing we're going to do is we're going to look at how much revenue does the company have. So I'm going to go back to Fiscal AI. I'm going to put this on the annual view. And what I see down here is they have basically just under $2.2 billion in revenue, 2.17. So I'm going to type that in. And I know, because I've read through all of their investor relations packets, which, by the way, you can also see right here on Fiscal AI. You can go right to the slides and look at this. I'm going to go to the end of these slides. And in one of them, they tell us right here that they believe that their free cash flow margins can be as high as, you can see it right here, 25% in the future. So if I were to give them a 25% free cash flow margin, then what would their free cash flow be today? It would be about $550 million. So what we do here is we put in the ticker symbol NET. We check and see what it's trading at now, because what we've got here is what it was trading at when the market closed. So let's say, where is it trading right now? And it is trading at about, as we pull this up, we will see that it is, I'm guessing, in the 190s. 205. Boy, it keeps going up. All right, so it's trading for about 205. So if the current share price is 205, we want this green box to be 205. But I'll add this, that I believe that this is a company that could have tons of growth. In fact, its revenue growth rate could keep accelerating for a while. I think management is prudent about not overstating what kind of growth they could get. But if we give it, let's do it twice. Let's do it with the 3% terminal growth rate. Well, then how fast does revenue need to grow, since we've optimized those free cash flow margins? How fast does revenue need to grow moving forward to justify this $205 price tag? And it's about 33%. So remember that. Revenue needs to grow at about 33% to justify this stock price. What if we give it a 4% terminal growth rate? Well, then it's going to be a little bit less. It'll be about 31%. So look, as excited as I am about Cloudflare, and I think it absolutely is something to be excited about, we need to remember that this company needs to grow its revenue by about 30% for the next 10 years. And we're talking about probably 30% growth next year. But the question is, how long will they be able to keep that up? I believe that it has such a wide moat, and it could have such pricing power once all of these companies build this into their ecosystem and build tools on top of this ecosystem, that it's not out of the realm of possibility for this to keep on growing and compounding for years and years and years. But that's just my opinion. Let me know what you thought of Cloudflare's earnings in the comment section below. And don't forget to hit subscribe to find out how Cloudflare is doing when they next report in 90 days. Until then, Brian, out.